Hi everyone, I'm Viren Mehra from Section F. My roll number is 566. Today I'll be presenting on the topic GST provisions in the real estate sector. I hope you all enjoy it.
So let's begin with the presentation. So let's have a look at the topics first that we're going to be covering during the presentation. So we'll be covering a few important terms, basically the comparison between pre and post GST era, GST on real estate construction material as well as GST on real estate construction services, some important concepts, few important points to be noted, concluding with few illustrations and finally the conclusion itself. So to begin, basically real estate industry is one of the most important pillars of the Indian economy. Real estate industry contributes between 6 to 8% to India's GDP and it stands second after IT industry in terms of employment generation. With multiple taxes applicable previously like service tax and VAT, with GST coming into the picture, indirect taxation in this sector is wholly revamped. So at the 33rd GST Council meeting held on 24th February 2019, new GST rates have been introduced for residential real estate, which will come into effect from 1st of April 2019. The new GST rates on residential real estate transactions have been proposed as follows. Now, GST is going to be charged at 5% without ITC on residential properties that are not part of the affordable housing segment, and GST will be charged at 1% without ITC on residential properties that are included in the affordable housing segment. The deduction in GST rates on real estate proposed by the GST Council will be implemented from 1st April 2019 and are expected to provide the following benefits. A simpler tax structure leading to greater compliance from builders, fair price of property for buyer, and the problem of ITC benefits not getting passed to property buyers is also eliminated. And finally, there's also going to be better pricing of residential properties as the problem of unused ITC being added to project cost is eliminated. And given are a few schedules of the GST Act, which just basically give a gist of what should be treated as supply of services, namely construction of a complex, building, civil structure or a part thereof, including a complex or building intended for sale to a buyer wholly or partly. And it's also to be noted that no GST shall be applicable where the entire consideration is received after the issuance of the completion certificate or occupancy certificate by the competent authority or its first occupation, whichever is earlier. So moving on with the few important terms that should be discussed would be the first one is residential real estate project. So residential real estate project of residential apartments basically with commercial apartments not more than 15% of the total carpet area of REP. And affordable residential apartment, it means having carpet area not exceeding 60 square meters in metropolitan city and 90 square meters in non-metropolitan city for which the gross amount charged is not more than 45 lakhs. The GST Council has announced the applicable criteria for eligibility of a residential property in the affordable housing segment as part of the 33rd GST Council meeting. Then the following are the key affordable housing segment qualified criteria, as we already discussed, as the total carpet area of residential property cannot exceed 60 square meters in metropolitan areas, and the same being 90 square meters in non-metropolitan cities and towns, and total value of property also cannot exceed 45 lakhs. So just to make a note also, for the purpose of this definition, metropolitan areas include Delhi NCR and Kolkata, Chennai, Hyderabad, Bangalore and Mumbai. And with the same rule being applicable in metropolitan 60 square meters and non-metropolitan 90. So what exactly is carpet area? Carpet area is basically the area that can be used to spread a carpet inside the house, quite literally speaking. It is the net usable area of the apartment. So it includes the thickness of the internal wall but excludes the balcony or terrace. So if we want to do comparison between pre and post GST era, so what was the old scheme before 1st April 2019? The following rates are applicable. GST at 12% was applicable on supply of real estate before completion, and a concessional rate of 8% was applicable for units qualifying for affordable housing. So provided that developer was allowed to take benefit of the ITC paid. So what this gist of this is basically that before the GST came into force, a variety of state and central taxes were imposed on buildings through the course of construction of housing project. While these taxes increased the cost of development for developers, no credit against this tax was available to the builders against the output liability. So, moreover, as buyers had very little clarity over various taxes and also the applicability rates, developers were in a position to manipulate numbers and they kept the deal to the best advantages. And initially, GST for real estate was kept higher, but the Narendra Modi-led government, which launched the revolutionary tax regime, reduced the rates in 2019. This was obviously done in a bid to make properties more affordable to the common man and also boost its ambitious housing for all by 2022 target. And now coming to the new scheme, the GST Council, as we discussed, it came from new scheme. It reduced the GST rates in order to boost the real estate sector. But the following points need to be remembered regarding its applicability. In case of ongoing projects, as on 1st April 2019, the promoter has the option to opt for all provisions of tax. If opted, then required to submit declaration in specified form to Jurisdictional Commissioner before 20th May 2019. If no declaration submitted, it shall be deemed to have opted for new provisions. Any project started on or after 1st April, then only new provision are applicable. Under the new scheme, ITC shall not be allowed. And if we come to the ongoing projects, here one needs to understand which projects will be treated as ongoing projects. So building where construction started before 1st April 2019 and building where actual booking started before 1st April 2019 and building which have not been completed by 31st March 2019. So here is the summary basically of what the before and after GST rates have been. So in the type of real estate property, you have residential property, affordable housing segment, which was earlier 8% with ITC and now it's 1% without ITC. Residential property in the non-affordable housing segment was earlier 12% with ITC and now it's 5% without ITC. Commercial properties were 12% with ITC and now they're also 12% ITC unchanged, not about commercial properties. So, with the intent to stimulate demand amid a prolonged slowdown, the government has reduced the GST rate on property transactions significantly. This could potentially lower the buyer's payout by 4 to 6% on the overall purchase. While the new tax rate without ITC will apply on all new projects, builders were given a one-time option to pick between the old and the new rates by May 20, 2019 for their ongoing projects. This offer was valid only for projects which were incomplete as on March 31st, as we discussed. The government's decision came after the developer community raised concerns on the tax liability in the absence of ITC. So here's basically a graphical representation of how the GST rates went about. In case of the non-affordable housing projects, it was 12% with ITC, and after new provisions, it was from 1st April 2019 onwards, it was 5% without ITC. And as far as affordable housing projects are concerned, the rate till Jan 2018 was 12% with ITC. Then 31st March 2019, it was 8% with ITC. And finally, after 1st April 2019, it was 1% without ITC. So, GST on real estate construction material. So there are basically two key aspects of GST applicability in real estate. The first is the goods aspect, that is the applicable GST on various construction material, and the second is the services aspect, the service of construction itself. So both of these contribute to the final cost of the property for the end user, obviously, and basically it's to some give a definition or clarity of GST is basically it's of two parts: the SGST, state GST, and the CGST, central GST. So we add both of these rates, for example, 9% SGST, 9% CGST to get total 18% GST and so on. So the following is a tabular representation of what is the GST rate on real estate construction materials. So building bricks, crude granite, marble rubble, fly ash blocks, roofing tile, natural sand, all of tax at 5%. Marble and granite blocks at 12%. Refractory bricks and tiles 18%. Glass for construction purposes 18%. Prefabricated structural components of building 18%. Marble granite other than blocks 18%. Finally, Portland and slag cement at 28%. So now GST on real estate construction services. So construction services also feature taxes that are applicable to various real estate transactions that can be considered as part of how GST on real estate is applicable. The following is a snapshot of GST rates applicable to select areas of construction related services. To be noted, GST is not applicable to the following construction related transactions: sale of ready to move in flats, resale of property, sale purchase of land. So in all the above cases, the sale purchase activity does not include the supply of goods or services as per the GST Act. Hence, no GST is applicable to these transactions. So as far as the services are concerned, under construction properties under credit link subsidy scheme will be taxed at 8%. Under construction properties, excluding the credit link subsidy scheme, composite supply of works contract for affordable housing, and composite supply of works contract to government agencies and local government bodies will be taxed at 12%. Composite supply of works contract other than affordable housing government agencies at 18%, and works contract other than government bodies will also be taxed at 18%. So let's discuss a few important concepts now. One of the important concept which has great relevance in this topic would be reverse charge mechanism (RCM) and what would its impact be. So basically the concept of RCM has been borrowed from the erstwhile service tax law. The scope of RCM has significantly expanded in GST, which may be adversely impact the developers. One of the significant additions to RCM under GST law is that if goods are procured, service are received from a person who is not registered under GST, a registered person under the GST has to pay GST on all such supplies. In case a service is received from good transporter, legal service is received from an individual or firm, services received from the government or local authorities like municipalities, etc., subject to exceptions, the developer has to pay GST on the same. Also, under GST, developer cannot adjust the tax payable under RCM against the input credit available from the GST paid on the inputs. Instead, it has to be paid by bank or cash payment. This will increase the cost and has a negative impact on developers, especially the small developers. There is also something known as the 80% procurement rule. So, as per this rule, promoters required to procure all capital goods and at least 80% of input and input services from registered suppliers. If not procured, promoters shall pay tax under RCM. Cement must be purchased from registered supplier only. If not, RCM at 28% would be applicable. In case of unregistered purchase other than cement, RCM at 18% would be applicable. This 80% limit shall be calculated at the end of the financial year, and any tax payments and shortfalls shall be paid by end of quarter following financial year. The promoter shall maintain project-wise account of inward supplies from registered and unregistered suppliers. The calculation are to be done financial year-wise, and registered supplier here means supplier registered under regular scheme or composition scheme. So input tax credit under GST is another important concept. So basically a unique characteristic of GST law is its ITC system, which makes it different from the previous tax system in India. From the start of a housing project till its completion, a real estate developer pays tax multiple times the purchase of goods and services. But under the GST regime, the builder would get input tax credit when he pays his output tax. So for example, a developer has to pay 25,000 rupees as tax on its final product. The builder has already paid 21,000 rupees as input tax while purchasing materials such as steel, cement, paint, etc. So in this scenario, he would have to pay only 4,000 rupees as output tax after adjusting the input tax credit. So there are certain conditions for claiming this ITC, which are a registered person will be entitled to claim ITC only upon fulfillment of following conditions. He has possession of the tax invoice, he has received the goods, the tax charged on such supplies paid to the government by the supplier, he has furnished a valid return, the goods and services should not have been used for personal use. So what is the restriction ITC? Input tax credit is not available on supplies received for construction of an immovable property on his account other than plant and machinery. So note the word construction includes deconstruction, renovation, anything, additions, alterations, repairs. So to give a few examples, example is like monthly developers, for example, constructs a building for its branch office. In this case, ITC is not available. And another example, L&T constructs a hydraulic machine used for construction of its branch office. In this case, ITC is available. So ITC in case of ongoing project where promoter shifts to the new scheme. In case of developer who are involved in the project and shifts to new scheme, reverse the excess ITC availed under the old scheme compared to tax paid by him on his output supply, entitled to get credit to the extent of less ITC availed by him in case he has availed less ITC compared to tax paid by him on his output supply. What's the valuation under section 15? In case total amount charged includes value of land, the tax shall be payable on total amount charged minus value of land, provided value of land should be taken as one third of total amount charged. So lastly, some important points to be noted. GST is not applicable on ready to move properties. It is applicable only on under construction properties only. It is important to note that GST does not cover real estate sector under its ambit. The tax rate applicable on property building is charged under work contracts. This is precisely why a developer cannot charge GST on the sale of ready to move in homes. So only upon the completion and after receiving occupancy certificate, a property is categorized as ready to move in and is out of purview of work contract. So in short, GST would apply on the sale of under construction properties only. Also, GST is not applicable on land transactions. The sale of land is also outside the purview of the GST and construction services, as the sale does not involve the transfer of any goods or services. As the cost of land is a crucial factor that determines property rates, GST provides a standard amendment of 33% of the total contract value towards value of land for taxable real estate transactions. Example, how to calculate GST on under construction property. Suppose that an under construction property worth rupees 100 is sold by a builder to a buyer. To calculate the GST on building, rupees 33 will be counted out as the land value and the GST on construction would apply on the remaining 77 rupees. So now let's have a look at a few illustrations to help understand the concepts better practically. So in this question, we're given basically different projects, its nature and the date of commencement of construction. We have to basically categorize them as what will be the RCM and if will it be RREP under affordable, non-affordable and so on. So for to take the first project, which is Station Road, it is a 100% commercial project and commencement was in July 2019. So it is an REP, GST would be 12%, ITC is available. Second would be Mall Road in Chandigarh, which is 91% residential, 9% commercial, where carpet area is not more than 15%. So it is RREP. GST would be 5%, ITC not available, RCM is applicable. Third would be Silk Road in Madurai. It is 70% residential, 30% commercial, and carpet area will be greater than 15%. It is REP. On transfer of residential apartment, GST 15%, no ITC available, RCM is applicable. And on transfer of commercial apartment, GST 12%, ITC is available, RCM is not applicable. And fourth would be Tarun Street, Kolkata. It is a 100% residential project and it will be a RIEP project. GST would be 5%, ITC is not available, RCM is applicable. And now to have a look at another illustration, in this we have to basically compute or discuss whether the RCM, reverse charge mechanism of section 9(4) is applicable. So we're given basically the different items and how from the source of which it had been procured, whether it's registered supplier or unregistered supplier, and we have to calculate any tax liability under RCM if it is applicable. So cement supplied by different unrecognized supplier in the month of November 2019. Z Limited, the total input goods plus cement plus input service, which is equal to 28%. Z Limited has procured 72% input services from registered suppliers. Therefore, RCM is applicable here. Cement procured in November 2019 from unregistered suppliers. GST is payable 28%. So 60 lakh 28% would be 16 lakh 80,000. After GST payment, cement is deemed that cement is procured from a registered dealer. In case of input services, 60 lakh minus procured from registered dealer during November 19. Purchase from registered dealer will be 78%. 78% is less than 80%, those a shortfall value of 20 lakh. 80% of 1000 lakh would be 720 lakh purchased from registered dealers and 60 lakh purchased from unregistered, but tax is paid under RCM. So total tax liability under RCM would be 20 lakh into 18%, which would be 3,60,000 input service tax. And to be noted, GST tax can add on any month but not later than June 2020. So to basically sum up and conclude, what has been the impact of GST on real estate? At the time of GST implementation on real estate, the industry as a whole was witnessing a slump attributed mainly to demonetization and the Real Estate Regulation and Development Act implementation. However, early in 2018, demand and supply for real estate witnessed an increase, primarily driven by strong growth in affordable and mid-income housing. However, housing prices were either stagnant or witnessed a marginal rise across the country, while in larger cities such as Delhi NCR, prices were reported to have witnessed a 2% decline. But such price declines were mainly result of oversupply rather than impact of GST. As in most cases, in ITC benefits were not passed on to the home buyer by developers. And even when ITC benefits were passed on to home buyers, the change in prices were negligible. So it is expected GST shall help in the decrease of the overall cost of construction and hence shall benefit the consumers. The government should interfere and enact the anti-profiteering provisions immediately and cautiously on the developers so that it will help to achieve the goal of reduced cost. The provision under erstwhile indirect tax law has not seen any major changes as compared to the GST law that would have caused real estate sector to worry. Hence, it is expected that GST shall bring smiles to people involved in the real estate sector. Finally, implementation of GST has a major impact on the real estate sector. While removal of cascading effect under GST as compared to the pre-GST regime is beneficial to all the real estate companies, however, restriction on claim of ITC, especially in case of residential projects in the new scheme of taxation, has defeated the primary purpose of GST, that is to allow unrestricted flow of credit. So due to new scheme of taxation, the companies having ongoing residential projects are required to review their cost sheets and identify the benefits of old scheme versus new scheme. While prima facie reduction in rate of tax is a welcomed move, however, the same has come with the cost of ITC. Thus, whereas consumers expect reduction in prices, in reality, such reduction may be very minimal or may even lead to increase in costs due to restriction in claiming ITC. The industry has to find out a balance between consumers' expectation of lower prices and developers' expectation to maintain profitability of the project. So that was the presentation. Thank you very much.